SC 240 Auditor's responsibility relating to fraud in an audit of financial statements. Fraud is an intentional misstatement which includes omission, that is, concealing truth. Example, not disclosing contingent liability, or misleading. Misleading means falsifying. Example, showing advance from customer as sales. Fraud is of two types: fraudulent financial reporting, misappropriation of assets. Misappropriation of assets can be of two types: misappropriation of cash, misappropriation of stock or other assets. First one, fraudulent financial reporting, intentional misstatement in financial statements to deceive users of financial statements. Under that first one, omission, not to account or disclose. Example, delaying expenses booking or advancing income recognition. Second example, not disclosing bonus or revaluation details in notes to accounts. Second one, manipulation. Manipulation means falsification or alteration of accounting records or supporting document. Example, fictitious journal entries showing payment to creditors to improve current assets ratio. Second, altering records. Sales contract is altered after signing to pass incorrect journal entries. Third one, misapplication. Misapplying accounting policies. Example, adjusting assumptions or judgments of depreciation, inventory valuation to increase profits, engaging in complex transactions so that accounting standards is not applied properly, like a repurchase transaction or finance lease. Next one, misappropriation of assets, theft of assets. Misappropriation of assets is of two types: misappropriation of cash, misappropriation of stock or other assets. Misappropriation of cash, example, suppressing cash receipts, inflating cash payments. Misappropriation of stock or other assets, example, stealing goods, using assets for personal use. Next, fraud risk factors. These are the factors which indicates fraud may occur in the future. Fraud risk factors are the events or conditions that increase chances that fraud can happen in the form of pressure, incentive, or attitude, or rationalization or opportunity. First one, fraudulent financial reporting. Under the first reason, pressure or incentive. Pressure is created because of financial stability or profitability is threatened by following factors: law, new statutory or regulatory requirement came, high degree of market saturation or competition is there, increase in business failure, significant decline in customer demand, new accounting requirements came, threatening bankruptcy, foreclosure, or hostile takeover, recurring negative cash flow, or inability to generate cash flow, though there is earning or growth in earning. These are the reasons for creation of pressure or incentive. Second, attitude or rationalization. Rationalization means a strong reason. Following attitude related matters may suggest inappropriate ethical values or standards communicated or enforced. History of violation of securities or other laws, excessive interest by management in increasing or maintaining earning strength or inventory price for tax motivated reasons, using inappropriate means to minimize earnings. A relationship between management and auditor is strained and exhibited exhibited by following: DRDU, frequent disputes, or restriction on auditor; D, domineering management, unreasonable demands on auditor; not distinguishing between personal and business transaction; failing to rectify significant deficiency. These are the reasons related to attitude. Next, opportunity. Opportunity may be created for fraudulent financial reporting because of following: tax haven jurisdiction, or having subsidiary or branch or significant bank account without any business justification; unusual or high complex significant transaction having difficult substance over form question; ability to dominate or strong financial presence in certain industry which allows to dictate terms or conditions to supply or customers; significant related party transaction not in ordinary course of business or where related parties not audited; Significant estimates affecting assets, liabilities, revenue, and expenses. Next, misappropriation of assets. Under that first one, pressure or incentive. Following circumstances create pressure for misappropriation of assets. Personal financial obligations, adverse relationship between entity and employee who have access to assets. Adverse relationship may occur because of the following: known or anticipated layoffs, or recent or anticipated changes to employee compensation or promotion, or compensation not as per expectations, and expenses already incurred or committed. Next, opportunity. Following may create opportunity for misappropriation of assets, are characteristics of assets, are circumstances increasing susceptibility, that is, changes of misappropriation of assets, chances of misappropriation of assets. Fixed assets which are small are marketable, no identification mark, easily convertible bonds or computer chips or diamonds, inventory items small in size and high in value or high in demand. Next, large cash in hand, inadequate internal control because of the following: inadequate physical safeguards, inadequate segregation of duties, inadequate system of authorization, inadequate records of transactions or assets, inadequate access control over important records, lack of timely reconciliation of assets, inadequate oversight of senior management over expenditure, inadequate management understanding of IT systems, lack of mandatory vacation for employees. Next, attitude or rationalization. Careless attitude evident from following: increasing chance of misappropriation of assets, not taking steps to reduce risks of misappropriation, overriding existing controls over misappropriation, no rectification of a significant deficiency in internal control, no monitoring of controls over misappropriation, tolerance of petty theft. Next, circumstances that indicate possibility of fraud. These are the indicators that suggest fraud has already happened: discrepancies in accounting system and records, conflicting or missing evidence, problematic or unusual relationship between auditor and management, discrepancies in accounting systems and records, access to system and record inconsistent with necessary, other unauthorized or unsupported transaction balances, transactions not recorded in complete or timely manner, that is, improperly recorded transactions, last minute adjustments having significant effect, tips or complaint about fraud, conflicting or missing evidence. Missing evidence, system development and program change testing and implementation documents unavailable, documents in original form, only photocopies or electronic records available, missing electronic evidence, missing cancelled checks, missing other important documents, conflicting evidence. Any area, hint is unusual mica, unusual changes in balance sheet trend, ratios, relationships, mismatch between confirmation and records, inconsistent, vague, or implausible relationships, responses of analytical procedures, fewer responses to confirmation, documents appears altered, specific area, conflicting evidence, specific area, inventory, missing inventory or physical assets, unexplained items on reconciliation regarding account receivables, large credit entries are there and other adjustments are there, difference between subledger and control accounts or control customer statements, difference between subledgers, control accounts, or customer statements, problematic or unusual relationship between auditor and management, time, unusual delays in providing information by the management, undue time pressure imposed by the management, denial to meet people or meet in private, those charged with the governance are system development staff, key IT operations, security staff, employees, vendors, customers to access records, electronic files for CAT, computer assisted audit techniques, managements, complaints by management, unwillingness to address internal control deficiencies or revise disclosures, others, accounting policy varies as compared to the industry, frequent changes in estimates, not from change in circumstances. These are the situations where there may be a fraud. Next, risk assessment procedures for fraud, collecting information to identify risk due to fraud. While performing risk assessment as per SA 315, obtain information for risk of material misstatements due to fraud. Source of information, inquiry those charged with the governance, understanding oversight of management's process, identifying and responding risk of fraud, and internal controls over risk of fraud, actual, suspected, or alleged fraud. Next, inquiry management regarding understanding process of identifying and responding to risk of fraud, assessment of risk of fraud, communication of above with those charged with the governance and employees, actual, suspected, or alleged fraud, internal auditor or employee, inquiry about actual, suspected, or alleged fraud, analytical procedures, unusual, unexpected relationship, including revenue accounts, need to be checked. Other information which indicates a risk of fraud, evaluation of fraud risk factors from above, which leads to risk of fraud, identification and assessment of fraud risk, identify at financial statement and assertion level, presume risk of fraud in revenue recognition, documentation when presumption not applicable, treat risk of fraud as significant risk, and understand related controls. Situation, auditor is unable to continue engagement due to fraud, misstatement identified due to fraud or suspected fraud, encounters exceptional circumstances, bring into question ability to continue. Report problem as per legal requirement, regulatory requirement, and professional standards. Consider if it is appropriate to withdraw. If yes, inform, discuss with management and those shows the governance and report decision to withdraw. Case study on actual or suspected fraud. Circumstances indicating possible misstatement. Consider potential effect. If material performed, if material perform modified and additional procedures. If it is material, perform additional procedures. If actual misstatement, whether indicative of fraud. If yes, implication on other aspects. Check materiality and ask for adjustment. If not able to conclude about materiality or no adjustment, qualify or advise the reporter. Further explain ability to continue and CARO requirement as per clause number 11 of CARO 2020, section 143, subsection 12, fraud reporting requirements.